Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings and Happy New Year. Thank you very much for joining us. It's Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, and joined by our mentor options mentor and educator extraordinaire in our LaDuc Trading service. And we want to welcome Hans Albrecht into this new year since we haven't talked for a whole month.
That's right. Happy New Year.
A month ago, we were actually slated to do a Wednesday. I was sick as a dog with no voice. The next Wednesday was Christmas. Right after that, it was New Year's Day. So here we are. And we really haven't gone anywhere very fast. I mean, the market has really been a sloppy mess since the Trump bump back on November 5th. We really have been going sideways, kind of like a crazy Ivan move under the surface with the main index, while the breadth underneath has been deplorable. So something that I follow very closely from an intermarket standpoint. And today, so December 2nd is when it actually started. Today's actually finally where it reached a level where it could get supported. But there's also this saying, as you know, that markets don't crash from overbought, they crash from oversold. And this breadth destruction has been really intense as yields and dollar have moved higher. So I think we should get some stabilization, but it would not surprise me if we do a quick little, volley into the pre-Trump bump. Obviously, everyone's got eyes on that prize of the gap fill. So let me get your thoughts on market health and direction. And then, of course, we can get into sector rotation and particular trades. And, of course, VIX. So what's your thoughts on this sloppy market?
Yeah, so you're right. People are hoping for the post-Trump election bump to repeat itself as a pre-inauguration bump. And in between, it's been a little bit of, like you said, just kind of, I'm looking at this chart right here, S&P return contribution over the past month. It's basically been the MAG. I mean, I don't know if you could call it MAG 8, but if you throw in Boeing on top of the MAG 7, you pretty much have a big chunk of the performance, whereas the rest of the S&P is down about 3.39%. So it's kind of back to the future again, isn't it? To where we were maybe 5-6 months ago, where it was kind of all about MAG. And we kind of talked about how this was a bit possible at some point if we did get that kind of higher for longer rates possibility, which I've been kind of thinking about since August, that might happen. I mean, I'm not sure they're going to raise rates at any point, but if we do get some data, some stronger data, what do you think of the data today, Samantha? I mean, we got kind of hot and cold on the job front, right? We sort of got a little bit of not as bad on the jobless claims, and then a little bit conflicting data there. So the market maybe took it as a little bit negative, but I think more of that is probably we're kind of sitting in this pocket of negative gamma. So, this is kind of one of our terms that we brought to the forefront last year when we talk about gamma. And as you and I always talk about, we have to pay, even if we're not option traders, we do have to pay attention to some of these volatility concepts, because and gamma is part of that, because it's the dog and the tail reversing roles here. The derivatives markets are very influential now on equity markets. So even if you don't trade a single option in your life, you kind of want to pay a little bit more attention to what's going on. So we'll talk a little bit about gamma as well. And I think that's basically to your question. I think we're just kind of sitting. I've been telling members, listen, anywhere below 59.75, and we're kind of sitting in that pocket of either sort of neutral or slightly negative gamma. It's nothing to be super concerned about, but it isn't that nice cradling, supportive, positive gamma that we had above 6,000, between 6,000 and 6,100 before that massive expiry in December. We just had this incredible, even after expiry, even sort of towards the end of December, we had this big, massive gamma sort of support there. And then as soon as we lost that after December 30th, after the near-term collar, of course, they rolled the JPM collar, but the near-term effect of that gamma was lost to us. Now it's kind of distant. It's kind of like we were near the planet. Now the planet is far away. So the collar doesn't have as much influence anymore, but we're kind of floating about, as I like to say, we're sort of free to roam about the cabin. And that's exactly what the market's been doing lately. I think partially because of that, and partially, I'm sure you would agree, is the rate environment is just kind of starting to spook people a little bit.
Finally. So this was the post that I sent out even Monday morning, right? So we're Wednesday, tomorrow the market's closed, Friday is non-farm payrolls. I'm not trusting very much the jobless claims. I'm waiting for a much higher trigger to get really worried, 267,000. So until then, it's really just noise. I'm waiting for the signal. Continuous claims do continue higher. And then we did have headline jolts, which was looking good, but underneath the surface, it was not. So data day to day is not what grips me. What grips me is how the breadth underneath the surface of the market is still broken. So I wrote this Monday morning pre-market, markets in in repair. I should say disrepair, but in other words,
Canada. You got the Canada on the screen
and
there.
Trudeau, of course, was the reason why the dollar literally on Monday had a big little snapback exactly at my 109.30, which is ironic, but 108 is surprise. So we're talking Dixie. This is the weekly. I know it looks messy, but the point is it's still very, very strong. And the market itself is not. So Mag 7 is still compensating with its strength for the headwinds that are growing. And that also includes yields. Now, I know I'm showing everyone right now the yield curve, the 10 and 2-year yield curve, but this was something that I obviously have very focused on. When I said September 18th, it's time for a yield spike, and then December 12th, ready for a yield spike. So this means that the 10-year yield is rising faster than the 2, and that's actually picking up speed. So now the market has gone into this chop zone because it is aware that the dollar is very bid. It's aware that the yield curve is steepening, which is putting literally term premia is positive, move volatility is picking up. And then you add to that, and you actually have oil that has come up off the ground. So when you kind of literally, it's trying anyway. This is crude oil chart. So when you start looking at Q1 2025, it's not really a great tarmac for a soft landing for corporate earnings when we talk about higher energy prices, higher financing costs, and then of course, higher dollar is very expensive when it comes to currency conversion. So overall, I am still focused on those three. At the same time, I can see that Mag 7, this is a ratio of Mag 7, right? So this is kind of imagine this is the Qs that have literally, since the January low, they've doubled. So Mag 7 is what is compensating for, in large part, this advance. You all know that, but if you want a reminder of that, here's another really great reminder, which is underneath the surface. Mag 7, 65% in 2024, of which S&P was 23 gain, which is very good, but that's because Mag 7 is such heavily, cap weighted. All the other SPY 493, we got maybe 5%. And that includes all the quantum and, all the AI and all the whatever. So the point is we still have a lot of, I would say, cover up by the strength of the Apple, the Amazon, the Nvidia. They have not, that sector, if we call it a sector, has not reversed. So this is still the problem. Underneath the surface, we still have weakness. Mag 7 is still holding up the market in expectation that earnings will grow 10 to 15% in 2025. Color me skeptical. And then, of course, we do have a rising dollar and yields, which is absolutely interrupting the bullish flow. And so that's what I wanted to talk about with you today is what do you see with option flow on the aggregate? Because I still see that and I wrote about this also on that Monday, that beneath the surface, breadth might be breaking down, but the option flow still leans bullish. And the North American active investors, they went from 100 to 60 in like a New York minute. So they're really fickle. They're nervous. They're waiting for Trump's policies to be announced. And when you get stuff like we had today, Trudeau on Monday, and then this kind of nonsense. So we know Trump is the master of distraction and confusion, and he's doing a great job. Greenland, go, right? So, there's all kinds of disguise, I think, for really what he's trying to leverage and get done. But the problem is the market doesn't know how to price any of this in.
Yeah.
Not for earnings or not, and not even for dollar in yields. All I know is my continued warning that this bifurcated market that I wrote about for clients, right? Like you said, dealers are negative gamma, and we could definitely trigger that 58.50 and get some more selling going. But ultimately, we're just trying to get through the inauguration of January 20th and then find out a little bit more about these programs. In the meantime, the dollar is moving higher and with all kinds of really good macro reasons. So even Trump coming in Tuesday morning and trying to talk it down, which was hysterical. He's like, the interest rates are way too high. It doesn't work anymore. That worked in 2017. It's not going to work in 2025. So again, I think we have to keep eyes on the prize. Dollar yields a little bit of the oil, but I think that's going to settle back down, and watch the option flow. But right now, it's not falling apart.
Well, and like you say, it's hard for them to control the narrative because the rubber's finally hitting the road here a little bit. And there are things afoot since they started to cut rates, or since they were hoping to cut rates even more. We've seen the 10-year run up 100 basis points. So there's sort of kind of it's a tale of two kind of rate environments in a way. There's reality, and then they're hoping to do something that may not be possible for now. And I keep telling people, well, the Mag 7 are kind of a place to hide, and they don't really care about interest rates. And I say that sort of tongue in cheek because sort of a line from there's one of my favorite movies about a boy, and the guy says, no man is an island. Well, no sector is an island, right? At some point, the economy does matter to those stocks. We can't just say that they're never going to care about interest rates. They don't care about interest rates because it doesn't affect their business, their business per se. They don't have to borrow money and things like that. So they're kind of these balance sheet heroes that everyone can run to. But at some point, if AI kind of eases off and the economy softens, then it will affect MAG as well. So for now, the narrative is hide in MAG while rates are high and the rest of the economy is kind of going, like half of the Russell is 50% floating rate. It's not healthy, but
no,
I
but
think that gets solved.
It's also one tweet away from this type of implosion accident where Jensen is at the CES conference, and last night he utters the words quantum, and then he follows it up and nods to his CFO that it's a good 15, maybe 30 years away. And then literally the darlings that have also been a momentum sector day trader's dream, right? With lots of options, very risky. And some of them are extremely parabolic. In fact, we created this list way late. Mikey was way early on all this stuff. But in any case, we have this list that has just been outsized. And then today they opened up to a very big trend reversal. So this is definitely what happens when you have a parabola very extended from its mean, and then you have literally one sentence and boom, they're down 30, 40, 50% because parabolas are trapped longs, and all you need is a trigger of volatility, and that creates liquidation. And so that's what we saw today. Mag 7 isn't that. A lot of these plays have been, they're unprofitable tech, but they pulled forward a lot of growth. Nvidia has pulled forward a lot of growth, and it's stunning, and everyone's starstruck by the celebrity CEO. But the point is, this is the air pocket of risk that I look for in everything. So we need to kind of just not be complacent. The market is definitely getting tested.
Yeah, the parabola market, I mean, that sort of didn't sit well with us. It was nice to see for equity holders, but that post-Trump parabola market and it wasn't even just in the IONQs, it was kind of all over the place. And so that just sort of brought forward a lot of potential performance. And I think the market's having to kind of work that off a little bit here. I think in general, from my perspective, we might disagree on some things, but I think in general, the data is pretty positive in the economy. I think there's a lot to be positive about, but hey, we've had a couple of years of 20+ performance, and it's we're gonna have to work things out a little bit from a flows perspective. I think that if we can get above, I'm telling members, listen, if we can get above 60-50, I think we start to get into an interesting place, right? So we're going to go from that short to neutral gamma environment back to, and it's not always intuitive, right? You think, well, buy them when they're on sale, but from a trader's perspective, it's right here, things are dangerous. But if we can get up to 60-50, then that's an area where I think dealers start to get saddled with a lot more premium, right? We get up there, everyone's hammering out their cover calls, they're giving them all sorts of option volatility, and that's going to create a much more supportive environment that's going to clamp down on volatility. And then maybe we can then start to kind of grind our way up. If we get up there. Now, if is an important word here, and gamma in itself doesn't really cause problems. It can be an accelerant, it can be It can be a decelerant to volatility, but we need that sort of spark. So we need something to kind of get us up there. Earnings season starting soon. Maybe that's the thing that gets us going. But we sort of pointed this out a couple months ago. We said, the beta to VIX of the VIX to S&P is just massive. And that's why I've been favoring you. I noticed you also picking some nice VIX trades as well, protective trades. Beta of the VIX to the S&P has been really, really high. And so you can see right here, this is showing exactly that. So when the market comes down 0.5%, 1%, 1.5%, we can see the reaction of the VIX. And here, since that August horrific week, we see that now whatever the reason is, maybe dealers are on edge since those days, but we now have this ability for the VIX to really, really react. And one of the charts that I like to show is this was from about a month ago. And I sort of looked at this and I went, boy, look at the steep skew on the upside calls in VIX versus the month previous. So what that means, I mean, there's a few ways to interpret it, but basically people are pushing up those out of the money calls, which is what you want to own if you believe there's going to be a severe sell-off or a crash, right? You want to own upside calls, which is a little different from owning downside puts in the S&P. In the VIX, you own upside calls when you want to play for that crash, for that big sell-off. And this either means that people are super, super hedged, or dealers are going, you know what, I can't sell any more of this stuff. So that probably has something to do with August and early September, where risk departments are going, listen, you cannot get into an ugly situation like that again. You have to, if you're going to sell this stuff, you better sell it for a whole bunch of money. And as a result, you can see dealers are already short a lot of calls in the VIX. So I think that continues to be an interesting place to place our bets from a hedge perspective, or even just if you want to create some alpha from a sell-off as a trader. I'm sort of talking about selling, Feb, I might move to March soon, but Feb 15 puts, 16 puts to buy some upside calls. That's what I'm sitting in right now. I'm out a little bit of money on those, but I think they set up quite interestingly. If you think that the next month or so might be a little bit concerning, and there's certainly a lot of catalysts that we could be looking at that could cause some problems, that's where we are. Now, from a gamma perspective, here we are. We can see this sort of red square down here. This is where we are. So this isn't rocket science. When I say below 59.75, this is where we have pockets of weakness from a gamma perspective, where volatility could continue. We've seen it a number of days this week where S&P is up 70, 80, and then it gives back, a good chunk of that. Again today, we rallied back, so that was nice to see. But if we can get up into this sort of 6,000 plus territory, that could do a lot for us. But gamma's a really big thing. From December 30th to right afterwards, we saw one of the biggest drops in gamma that we've ever seen. Only August 5th was from pre December 30th. To afterwards. So a lot of gamma kind of disappeared there. And so now you have this, they say the largest 4-day change in their data set ever in terms of going from positive and flipping down to negative. So they've gone from positive 12 billion per 1% move when you're positive, you basically have 12 billion to buy, 12 billion. That's very supportive. This is an area where there is that possibility that you kind of can't trust the rallies, and maybe you can't really trust the sell-off. So we have to get used to this volatility until we get down. And I think that happens maybe around 660, 50. Where maybe things calm down a little bit. Here's your return contribution.
I love how you said that, by the way. You can't trust the rallies, you can't trust the sell-offs. And I literally have said, I don't trust this as far as I can throw it, meaning we're just in this chop slop, and yet the option flow is still hanging in there. We have you seen any other kind of indicators of worry?
I mean, apart from the sort of gamma picture that we're seeing, not really. I mean, I'm sort of looking at areas. I know you think that that the semiconductors could have a little bit of a run. It almost looked like we were going to get going the other day.
But I also said that popped up $10, the SMH, and I literally posted in my swing channel, right? Because I have that Nvidia finance call spread for March. I said, all right, I'm taking 50% of that off because it's up 5,600%, but I'm keeping 50% because I still have March. I mean, I'm keeping the 50% of this open because I think that after we fill the gap that we just made, this absolutely exorbitant jump in semis too, right? From 252 to 262. I said we have to go back and fill that, and then we can continue higher. So the fact that we came down the next day, okay, it was a little sudden, but I knew we were going to come down and go fill that gap before we move higher. So that's another reason why, believe it or not, I'm not worried about that long in Nvidia or SMH. I still think the Qs can hit 548. SPX can hit 6150, but not right now. Right now, they've got to let go. There's this clench of concern, at least getting through, I think, January 20th. And then I think they'll be able to move.
That's right. We need the
more
unclenching. I've seen somebody call it that. They call it the unclenching. We need a bit of unclenching. But I like it. I have to admit, I've been impressed with your resolve with that area, and it keeps coming back. It had a nice little run there, and that really ugly red candle yesterday. But I'll tell you why I'm still maybe a little bit. I think the news was positive. I know it was a bit more retail oriented, but it's a retail kind of show. I think there's more to Nvidia than the sort of prevailing narrative. And I mean, the AI is really, really huge, but the sort of other spokes in the game, I think, are sort of revealed themselves a little bit. They've got this $3,000 computer. They've got these deals with a number of Chinese car makers. They've made it clear that they're going to help others succeed in the robotaxi game, which maybe led to partially to some of the Tesla weakness. So I think Nvidia is still in the game very much in a lot of different ways. Kind of reminds me of, I remember 2018, I was really focused in the blockchain area. And that's all anybody could think about was, oh, Nvidia is all about blockchain. And they just kind of forget about everything else. So don't forget this company has a lot going on. It's not an insanely expensive stock. And so I'm looking here, I can see it's going to have to get through that 150 call wall again. I thought it was a little bit horse out of the barn, but here we are. We're going to have to kind of scale that wall again and jump over the other side. But once we get up there, there's not a lot of flow in the way at that point. So I think that's kind of interesting. And look at the SMH, aggregate dealer gamma. So we're talking about gamma again here, folks. So hopefully everybody's kind of on the same page here. Basically, we're a bit positive gamma in here between 240 and 260. We've got this wall around 265, let's say. But beyond that, this reminds me of when Nvidia was under 120. And I said, if we can get through 120, we could sort of melt up from there. This gives us the potential for a melt up as well. We can get that SMH back to 260, 65. Then the coast is pretty clear for a bit of a melt up. So I'm not saying it's going to happen.
262, 63 on a weekly close, to be exact.
Okay. That could be it. There you go.
But I also have mentioned repeatedly, add time. We have got to get through this January 20th, chop fest. And then NVIDIA earnings are September 19th. So it could run up, and that was my goal, really. It would just run up into earnings and you could, buy the rumor, sell the news. But for right now, it's fine. Like I said, I'm not worried, except underneath the surface, I do see this air pocket of risk for more of this intraday chop. Fundamentally, macro, and then of course my intermarket, and then just the flows and the net selling. It's still in the house. So they're not buying this narrative that we're ready to go higher, period. But options is still sticking around, and dark pool activity for investors is still positioning in tech. So they're also not, they might not be buying aggressively, but they're not selling. So kind of like I don't trust the rallies. I don't trust the sell-offs. We're just waiting to get through this period. No question about it. But I think Rish is kind of mentioning he treats this on a weekly standpoint of looking for drama of in other words, crash scenarios. I kind of look for a reason to crash, which is why I study the yields so closely with the dollar, because once we leave that Goldilocks region, then we absolutely have a reason. And if I see selling underneath the surface, which we have, by the way, we're leaving the Goldilocks in the 10-year and soon in the dollar. So if we don't get intervention to tap that back down, and Trump talking it down is not going to work, then I look for the structure of the market. And right now it's bifurcated. They're underneath, they're selling the underlying, but they're buying the options. It's almost like it's a proxy. They're lightening up their risk. Is that a better way of putting
Yeah,
it?
could be. Yeah, it could be a little bit of stock replacement. You know, you kind of take some risk off, some higher delta risk, delta one risk, and you kind of replace it with some upside convexity, some optionality to the upside that can maybe kick in if we do get another melt up. But in the meantime, you're going to create a little bit of dry powder in case you come back down. So there may be a little bit of that happening. I mean, I'm sure your typical fund manager isn't going fully to cash, but if he or she goes from 98% to 92% or 90%, that's probably a big deal. So that's probably where you can maybe move the needle a little bit on the option side of things. And so for me, for Nvidia, for example, I think it kind of, and it sort of hung in there today a little bit. I'm playing for that upside. So I did my own sort of financed upside play yesterday. So I've placed the bet again to sort of see.
Good, because you actually got all that nice IV crush and they came in and filled that gap. So you swooped in and got a long position. How is it structured? Because I can't make out those tiny little lines in toss.
So I went in and I sold the 130. I did a little bit higher. I didn't grab this low here, unfortunately, but I did a little bit higher. I sold the 130 puts for around 6.25, I think it was.
Close.
And then I picked in April. So I'm giving myself a little bit of time.
Okay.
I'm saying, I think Jensen's kind of put a little bit of a floor in it. I think unless the SMH drops, unless we see another decent drop, I think it's still technically is still sound. So this is an area where I think in this kind of market, for folks watching, you want to make sure that anything you do is on a name that you don't mind owning. So if you're selling a cash secured put, it's not on, IONQ, because you may not want to own that thing. And you may, I'm not saying you don't, but you want to be very, very comfortable in this kind of environment. If you end up bag holding, you want to make sure it's something that you're very comfortable with.
So this is why we do this format, though, right? Is to teach ways not to be a bag holder. Case in point, I have a client who is skilled, very skilled with advanced options, but he has IONQ. And my very first thought, I had two thoughts, actually. One was for Mikey, my live trading room moderator, because I know that he had a trailer left on that trade because he's been doing the quantum for a month now. So he's been very, very active in that and posting about that. But he just had a runner, so it wasn't a problem. And he also rolls his options. Client Tim, I know bought recently and got more Google, and he's a longer term trader. But as soon as he's profitable in that trade, he starts selling calls against it, starts buying puts to protect it all the time. So I literally asked him first thing when I opened the trading room, and he's like, don't worry. Took my gains on the January covered calls. I resold my July calls. I collected, blah, blah, blah. And I have puts. I have nothing to lose. That's what I love to hear. So that's the kind of thing I want if you're in this room right here and you're not familiar with how to protect. Again, IONQ lost big today, and he has the underlying, and he's got options 3 different ways that I'm reading from the Q&A from my Zoom this morning. He's fine. So those are the kind of questions we want you to ask here. You don't have to play VIX. I'm not really that fond of VIX either, if truth be told. But the point is, the very first thing is, looking for crash situations and then just playing them week to week can be frustrating if it doesn't have the intensity of the move that you want, right? Like I have been waiting for small caps, IWM, to fall into the 200-day. We're $3 away. Come on. But we stopped going down. And this started literally December 2nd. We stopped going down the past 2 weeks. The holidays, nothing moved. I still am convinced we're going to go hit 215. So you got to add time. And that's what a lot of folks don't do. They really want that hit by Friday expiry.
Well, and this is, and really one of the nicest ways, we can always go back to the good old standby classic caller, because sometimes the problem with something like IONQ or anything that has kind of high vol associated with it is that it's very, very expensive to protect. So what you can do is you can kind of say, well, is there a way to protect but also finance that? So the way that you and I like to do our upside finance plays, this is flipping that concept on its head. Instead of selling a put to buy some upside, you're going to sell some upside to buy a put. And in a stock like IONQ, I imagine that you're getting quite terrific. Let me take a look here at the call skew that you're getting.
A lot. And just to kind of clarify, though, if I'm selling a put to buy a call spread in Nvidia that's moving into earnings, we already know that IV is juiced. So the premium's really nice, right? After, with that crush, it's not so fun. So, it's also, you got to pick the timing of when it has maximum kind of impact.
It's a little bit of timing. And look, I've gotten rolled on callers as well. So, and that doesn't mean losing money. That means I've gotten capped on it, right? So if I'm short a call to finance some downside puts, I have to also accept that if the stock keeps going up, it happened to me on a Chinese stock, and then everything went. Now I made money. I could have made more, but that's sort of the rub when it comes to the caller. But I like it in an environment where things are starting to get a little bit scarier, and you suddenly feel like in a VIX 12 environment, I'm not really collaring much at all. I'm just kind of letting the market do the work for me. Once things start to get a little scarier, or in a name like an IONQ or one of these other parabola stocks, downside protection is very, very expensive. And so the nice thing about a caller is it can be sort of volatility agnostic. It doesn't really care so much because the whole surface is lifted, right? Now, puts are often even more skewed to the upside. So you're going to have to pay a little more for that put, but the whole surface lifts. So you're still getting something for that call, a reasonable amount for that call. And that's going to help you to finance the downside. So if I look at IONQ yesterday, you could go into Fab and maybe sell like a Fab 60 call, which would have been $9 above where it was trading on the close yesterday. Yeah, exactly. So you could buy that for about 540, pick up a 45 for 560, even pick up a 40 for 350, and you even put a couple bucks in your pocket, or you put $1.50 in your pocket, and or what is that? I'll put 540 to 350. Yeah, so you put a couple bucks in your pocket, and you've created some protection that's going to have a little bit of Vega exposure too, right? So the implied vol, if it explodes, you're going to do well. Let's take a look and see what IONQ option volatility did, because I love to take a look and see here. We can see yesterday. Oh yeah, look at that. So we were trading around 115 implied volatility, very, very flat skew. That's kind of interesting. I wonder if that's even accurate. That looks a little bit strange. But 115, and we jumped to almost 150 today. So volatility exploded to the downside. So you would have benefited from some of that Vega exposure in a Feb or a March position. You would have enjoyed some of that expansion of implied volatility that would have given you extra kick in your put. So the thing about the caller is it does limit your upside, but you don't have to accept that. I mean, you can roll up the call. There are different things you can do to kind of repair that upside call that is going to cap your position. But the point is, you have a stock that's gone from whatever it was, 10 to 50, and you're just trying to protect some of that if you can. So never a bad strategy to have some callers. I know advisors who just kind of caller, all the time, just because, they're not trying to hit home runs all the time. They're trying to make a reasonable amount of money, but also protect. And when you have that extra little piece to sort of play around with, when you have that put, doesn't mean you have to just sit on it and wait for it to expire. You can monetize that, even though it's a Feb or a March or a June or whatever. You have every right to go and sell that put. And now you've really, you've protected a good chunk of your position. So definitely something to keep in mind.
So one of the trades that you had, I know it was last week, and the market seems to change so dramatically on one headline, right? So right now they're focused on yields and dollar finally. The past few weeks, it's been the quantum, excitement. For one day, anyway, it was Nvidia and semis before Nvidia did a 8.5% intraday peak to trough dump. So right now, what are you looking at for a sector that interests you? And how did you trade the MSTR? Because Bitcoin really hasn't gone very far, but you did play a bounce. And I know that you structured it three ways. I think one is still open.
Yeah, I still have one of the legs open. I'm short an out of the money put, but I took off the high delta position. So I had a strangle rather, and an upside risk reversal. So an upside play. And so I did that just to kind of show people the different ways that you can approach the situation. But there was sort of a big kind of lead up to it. So around December 18th, I put out a video and I said, look, I think the next play in MSTR is going to potentially be a long option play. And the reason I felt that was we'd gone from, say, this is sort of a good little kind of run through as to how you might go over assessing volatility on a stock and looking for, is it high, is it low, and that can always inform what you're going to do. So of course we had the big run up to 550 where the implied volatility got to 220, which was pretty amazingly high, got quite a bit higher than even realized volatility, which is how the thing is moving. So there was some real panic to the upside there. And part of that was frankly just people just kind of clamoring to buy calls. That call skew just exploded to the upside, which was very much an exhaustion move for that stock. So we can see that right here. We can see the call, anything below the zero line means calls are expensive. Anything above the zero line is puts are more expensive than calls. And here we can see that we basically tagged that early March level of everybody just rushing into calls. And that was kind of a nice exhaustion sign that maybe that was getting close to the top between 500 and 550, and it was. So then we sort of pulled back, and then I've been calling for Bitcoin to kind of sit around 100,000, which it has. Basically, it's kind of gone from 107 to 90, low 90s, I think. And I was in a position in MSTR, and I got out of my position around 440. It was a nice little win. And then I didn't touch it. I had a coin position, which I made a little on, but got out of it. And then I figured, you know what, Bitcoin's calming down. I think MSTR could be a little vulnerable here because it's, as we know, it's sort of whatever was trading at 2.5 times NAV. And once you get that parabolic move in Bitcoin out of the way, then sometimes gravity kind of pulls something like this down. And so it came down towards 300 the first time, and I didn't buy it. And I said, you know what, I'm waiting for this signal to get to my zero line. So think of skew this way, and it's a bit unusual in something like MSTR because this is not the typical skew you're going to see in S&P. In S&P, you always get expensive puts versus out of the money calls. So you're going to see S&P skew always up above that zero line. This is a very different animal because of what it is, right? It's something people want to own for the explosive upside potential. Mm-hmm. And it typically trades with those calls being much more expensive. But every now and then it gets to this zero line where calls and puts are evenly balanced. And I said, well, I'm not getting into this thing until I see calls and puts balanced. Why? Well, because to me, that's going to signify a little bit of panic to the downside. So when calls are expensive, that's not panic to the downside. That's probably panic to the upside in this product. For S&P, very steep put skew is going to be signaling panic in a product like that, or in Microsoft or in Apple or something like that. You're going to see put skew blow out when they pull back. But in this particular kind of product, I was looking for puts to get relatively expensive versus calls. Now, they're not going to get, that's the thing about skew. People sort of look at a number for skew, and it doesn't really have any meaning on its own. It kind of has a little meaning, but skew is interesting only when you look at it in the context of, well, where is skew for this product? Because skew for MSTR is different from skew for SPY, for example. In this product, when the puts and calls are balanced, that is usually a sign that a change is about to come. And I literally said, when we get to this line, we were down around here on December 18th. I said, if we get to there, that's my buy spot. And guess where that buy spot was? It was 289 on the stock. And I said, okay, that's the spot. I waited for one day. It bounced up to 304. And then I put on this long strangle, as well as an upside risk reversal play, as well as just a plain old short put. So I wanted three things for students and members to look at, which was, I wanted one income play, pure income, which is just, okay, let's sell an out of the money put because we feel the bottom is in on this thing. The put skew is a little bit expensive for this, right? It's not technically expensive because it's the same as calls, but for this product, puts are expensive at that point. And then I wanted a long strangle, which I don't do many of, but I said, you know what, if we get down to a certain level, and this is where we were, volatility got to where this blue line is, and basically tagged the level from early November when it was down in the 200s, and really levels that are kind of, you can see going back way back when it was even in the low hundreds. So to me, that was a good spot to kind of get long the strangle. And what you do with the strangle is typically you buy an out of the money call and you buy an out of the money put. And I bought the 230 put and I bought the 330 call. Now the thing about that is it's delta long, right? So if you make it neutral, you just kind of make the call pretty far away and you make the put pretty far away. And then you just kind of go, okay, what I'm playing for is a big move. I don't know which way it's going. And I think volatility is relatively inexpensive, right? That's the key with being long any option really is you've got to really, the bar is higher for you. As an option seller, you can be wrong in a lot of different ways and still get away with it. As an option buyer, you're battling the forces of time, of theta decay, of vega, which is, the vol could drop even more if it just sits around. So you really have to you've got to wait. When you're long options, you kind of almost think of it as waiting for that 5-star trade and letting those 3 and 4 stars just go by you. And if they turn out great, whatever, you didn't do them, that's fine. But you really have to be right in a lot of ways when you're long options. And so I gave myself till March. And it just so happens that it moved within like 3 days or something like that. So it exploded.
The Nvidia I have for March, I did not expect that to be within 3 weeks. It was a 3-month. So this is the same idea.
Yeah.
It's wonderful if it happens sooner, but
Exactly.
I'm not so hyper focused on it. So finish this up because I definitely want to ask you a few trades that are client interest, but also I'm curious how in your system you see them.
Okay. And anyway, this one bounced. We had the two-day bounce. I got out of the strangle. I think I made 56% in a few days, which was good. On a one lot, it was like $3,500 or something. So that's pretty good. Up to 360. The silly thing was it went to 380 that day. So it could have been even better. But of course, it's pulled back. It's given back a good chunk of that over the last couple of days as Bitcoin has pulled back. So this is very much in play. I'm going to be looking for the same signal again. I'm going to be looking for that skew to get close to that zero line again. And that could look interesting to me. Now you see again, implied volatility has dropped. So option pricing is starting to drop again, but I think it might not even get that low because I think it's very much in play and we're past the Christmas season. So I don't see it getting too low. So I may be looking to buy it again if it gets just a little bit lower. The risk reversal did really well. And the short put, we've just kind of held on to because it's my lowest delta play, right? So what I did was I took off the high deltas. The call spread on the risk reversal was at 330, 360, and we were trading at 360. So it's, that call spread is kind of, it's max, right? It's max. I mean, look, it's going to make more money as vol comes down as time goes on. But I got in to make a bit of money, and it happened quickly. So you grab it, and then the strangle. Of course, you got to monetize that. One thing about long options is you're monetizing. That's kind of in your mind. Whereas short option plays, you can kind of go, well, okay, I'm going to let this play out a little bit longer. You got to be fairly active with long options. Especially in something that has such high, that one of the parts of my thesis was, just to finish up, Samantha, was I said, you know what, if this moves, we're going to get this expansion of volatility again. So, and that's exactly what happened. We went from 100, low hundreds to about 120 vol. So that's part of the beauty is I wanted both delta exposure, which is direction, because I set myself up long, but I also wanted vega exposure because I thought this is just too low. This thing's if it makes any kind of move, we're gonna see volatility expand again. And it did. So it was kind of a nice, from start to finish, the planning stage, and then it was kind of like
an excellent play-by-play and how you can be very flexible using options. All right. So take a look at GLD. That's a client request. I have been waiting also for this to set up. I warned on October 29th, definitely not safe into Trump. Looked like it was going to roll over. It did. And obviously gold and silver have stayed rolled over, but they haven't dropped further. So that's good. From a trend perspective, it's still fine. But from a swing perspective, there was just no more juice to squeeze. It was definitely October 29th into the Trump election and then since. So now the question is, how is GLD, just as an example, setting up?
I mean, I think the volatility is actually kind of low in there. I don't think it's very expensive. So I wouldn't be excited about if I were long GLD. don't think I would be selling calls at this point. It's been kind of sort of flatlining a little bit. I mean, it's had a few little moves in here, but I'm not excited about selling implied volatility. I might, if I were looking for some upside, I would be looking to set up a long call spread, something like that. I'd have to look at the skew here. You know, it's got that, this is sort of typical, right? For gold is you get that upside skew. It's a bit like coin complex, right? People play it for not the same reasons, but it's, you know, they're digital gold and this is, you know, it's kind of in the same realm that, you know, you can buy a call, let's say a slightly out of the money call, and you can sell a higher priced call up here, right? So that this skew isn't as pronounced right now as the 52-week average, but you're still getting that. So if you like the upside, you could look at an upside call spread. You could even look for just, I think the option pricing is cheap enough that you could just go and buy outright calls and puts for your expression of where you think things are going. Is this client sort of bearish or bullish or?
Rich just mentioned GLD 250 March call, you know, popped up. And so kind of had you look at the GLD. So no, this is definitely, it needs a little bit of time. Actually, I have a level it needs to get above, which is that 250, 247 and change. But basically it has a look, but it hasn't triggered. So anyway, gold and silver is one client request. And then speaking of this big growth momentum that we've been in, that the reverse is that value gets sold off. It's a source of funds. Basically, they sell their XLV, XLP, XLU, and they go into the Mag 7. That's quote unquote defensive, but it's also the balance sheet of heroes and such. Now,
Look at this, just quickly, Samantha. Look at this. Silver options are cheap. Look at that. They're as cheap as we've seen since early in the year, maybe back around March when silver was down around 20, 21. That whole precious metals area is cheap. I wouldn't be excited about selling calls or puts in here in that area. I'd be more excited about setting myself up with long call spreads, straight up options. I think that to me is pricing kind of nicely.
All right, so this is a chart. So you know that I focus on this growth value rotation, and I'm not saying that it is done yet at all.
Show us my favorite chart. There it is. I love
okay,
that
well, that's
thing.
one of them. I hopefully I have a few, but this is the growth value rotation, which you can't see very well, but it is churning here. And it's done extremely well. And as I mentioned, literally it triggered on December 2nd, exactly when I saw the selling underneath the surface with NYSE and basically the value components. Now, it has been digesting, right? Growth is still in play. You can't excuse the fact that we're really close to all-time highs, yada, 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 even if we've gone sideways since the election. December 2nd set free this growth rally, and underneath value got dumped. Now, let me just transition to what I wanted to show you, which is Coca-Cola has really, come back down, which is, looking like it's trying to stabilize. But these three in particular caught my attention, and they're dangerous because PepsiCo has obviously broken trend on any time frame you look at. But now it's down to a favorite moving average of mine. I happen to like the 400 week because this is oftentimes where we see a bounce form. So we're talking PepsiCo at the 400 week. If you look over here on my weekly, it's a little bit more impressive. That's what I'm trying to get across. Same thing with Celsius, which is another drink. Now, again, RFK Jr., Health and Human Services, these things are going to have a tough time. They also were just extremely, again, I believe, source of funds to go after the Mag 7. But now you've got this 400 where it's been also getting supported, and a look for me, which is this crossover of the 10 and 21. Again, I'm on a weekly. I'm looking for oversold bottom fishing plays. Celsius is one, PepsiCo is another, Mondelez is another. These are all the staple plays that have been sold off. Look at the forced selling right down to the 400 week. And all I'm trying to get at is typically oversold plays at least have a bounce in them. They've done nothing right yet. So what is your skew? What is your kind of like option read on some oversold value plays? That's the question.
Typically, I mean, if I don't have a lot of conviction on the bounce, so if I don't already have a little bit of momentum as a tailwind, if I'm just kind of trying to pick the bottom a little bit and I'm seeing some stability in those areas that you're describing, then I kind of like looking at selling some out of the money puts, because if you go long calls, then you're just kind of, you better get the bounce that you're looking for, or probably.
So where would you what month, what date
Yeah.
expiry would you? Since remember, this can churn sideways, like I showed you with the Celsius for a few weeks. It doesn't necessarily
can,
gonna
yeah.
mean it's
Yeah. Well,
SMCI did the
Celsius.
same thing, by the way. SMCI came down to the 400 week and then bounced vigorously. So they're technical, but it also happens to fit with this value trounce. And what I'm
Yeah.
looking for is stabilization, where we get a potential rotation away from growth and back into value, or at least start to broaden out this quote unquote rally, which really there's nothing broad about it. It's all Mag 7. So
Yeah, it is. I'm surprised. I haven't looked at PepsiCo and Coke and a few of
I
these
know
names.
there's
Like,
no reason to.
it's unbelievable. Like what a
Yeah.
pullback in some of these. Mondelez chart was unbelievable. So I mean, they really got excited about that. I don't know how much is RFK and
It's both.
Ozempic.
No, it really is. It's the trifecta, a little bit of that Ozempic. It's definitely RFK and source of funds. I followed this with my growth value rotation so closely. So we already saw this rolling over. Literally XLV the week of September, very first week, it had a bearish engulfing. XLU did not, because it had the data center, the power producer plays, the Constellation and small nuclear reactor. Forget about it. The utilities was not selling off. And then XLP definitely started to. Point is, those four, as an example, oversold value on the 400 week, selling puts if you have some conviction, but which dates?
Yeah, so I'm looking at Pepsi right now. I can see volatile is the option pricing is a little bit high, and I'm going to chalk that up to we must have earnings coming soon, right? We've got 11, 12. Yes, it's coming up. Must be any day now, almost.
No, it's February 4th for Pepsi.
Oh, is it really? Oh, okay. 11.
Coca-Cola, it is February 11th. Mondelez is February 4th. We got a lot of consumer discretionary staple plays coming out very beginning of February. And what was the other one I mentioned even?
Mondelez, Coke.
Oh, CELH.
Oh, CELH. Yeah, CELH is, I
That's not
played
until
that.
March.
I got hurt on that once, and I was pleased to see that they still carry it at Costco. That makes me think they're not going out of business yet, because that chart is just really quite unbelievable. But something like that, yeah. I mean, look, I don't know if I would jump into CLH. It's an interesting one. That would take a little bit of work to kind of dive into. I mean, it's definitely due. It's definitely due for some sort of bounce. Could have said that 3 months ago too, and it's just kind of sat around. So it's
not ready for a bounce. I can tell you, this is what I follow very closely. So this had already been a short. And the fact that it stayed below the 10-week beautifully and has only recently started to toy with it in the middle of December means that it's ready to have a bounce. It doesn't mean it's a trend reversal, bottom fishing trend reversal, but it's definitely due for a bounce. So that's actually one way
that's a play where. So I'd say, Samantha, that if you don't really feel strongly. Now, this is something where, in my view, what you would do is you would start with the short put play. You could sell a put, you could sell a put spread. So in Pepsi, for example, I might go into February, and I would look at, I'm imagining the vols aren't really great here, but you could sell a 140 put for around $1.66, Feb 135 put for maybe around 86 cents, something like that. It's not really going to move the needle a lot for you, but it's a little bit, right? So it's a little bit of premium. And then once it starts to kind of shape up a little, that's where I would transition from the short put play. So if you can grab, a little bit of premium on those puts, then your next play, once this actually starts to shape up on the chart and looks like it has maybe a little bit of potential to move to the upside, as opposed to just kind of consolidating, which is, that's the stage we're in right now. We're kind of in that yellow zone, right? This is not green, and hopefully it's not red. Maybe we're starting to get out of the red.
And the market is also doing the same thing, right?
Yeah.
This is when I look for inflection points in sector rotation, FYI. So when I'm seeing this consolidation, of course it can break out higher. But my point is, this is when we typically start to base in those value plays, we start to move higher. But we got to add some time, because it hasn't done anything right yet.
So that's your basing play, right? So from an options perspective, your basing play is going to be, okay, I feel this is kind of starting to base, kind of start to consolidate a little bit, find a bottom. We're not trying to catch that falling knife anymore. The knife is kind of landed,
Correct.
hopefully. And we're going to sell some puts. We're going to try to extract a little bit of premium harvesting out of that. Once that chart starts to look good again, that's where you can transition to an upside call spread. That's where you might say, you might look at the skew and figure that stuff out. But generally speaking, you might say, okay, I'm not massively convicted to the upside, but it's starting to look good. That's where I would buy, say, an out of the money call spread and just kind of say, okay, I'm going to buy a call $5 out of the money and sell one, $10 out of the money. And then once I start to feel really good about it, or it starts to move and pull back to a spot on the chart I like, that's when I might do my finance play. That's when I might go, okay, I'm going to sell a put and use that put to buy some upside. So there's different sort of stages of what you might do.
When I have high conviction. It has to be, for me, it has to
Right.
be, what did you call it? You had your 5 or something.
The risk reversal, the upside.
No. Earlier when you were talking about your 5-star, that was it.
Oh, the 5-star. That's right. When you've got 5-star, well, that's where you can, when it's really 5-star and you're jumping on momentum, that's where you can just kind of pick up some calls and,
Yeah,
especially
if you're chasing momentum, calls make sense. Waiting for
Right.
a reversal, selling puts, and then a call spread. Very helpful. Okay, so I think we covered the fact that we're both in the market malaise, waiting for the Trump inauguration, for that smooth transfer of power, and then some policies revealed how this is going to really look. Slow tariffs fast, how they really are going to deal with Ukraine, what Trump can accomplish, because that would be potentially very beneficial to dollar and yields softening. On the flip side, if he escalates with Iran, it's very bullish the dollar. So the point is, we've got we don't have a way to price in a lot of things, but keep that in mind. Q4 earnings is definitely starting. The headwinds right now that we have of higher yields, dollar and energy, will affect next quarter's earnings. And then really we just have to get through, I think, some of this slop. But big picture, I think you and I are both kind of looking for that dealer gamma to right itself and move higher. Yeah. I am warning, we still have an air pocket of risk underneath. The market is still in repair. If I saw all of my indicators as go, I wouldn't have paused in my trading room this morning for about 10 minutes going, it still doesn't look good. I don't trust it as far as I can throw it. So intraday bounces, okay. But I'm talking about a resumption of the trend higher. We ain't there yet. So that's my conviction.
Yeah, don't force it. Exactly. Don't force it. I think that's, that's one of the things that retail can really stand to learn, is that, listen, you don't take what's in front of you. The market's telling you that there are a lot of charts out there that need to repair themselves. There are a lot of indicators that need to get, it can be just, have a MACD on your screen and just kind of wait for that thing to recycle, right? That's one of the nice things about some of these indicators, is they kind of take some time. It's like turning around a ship. It takes a bit of time, but once it's turned around, it can get going again. We
cover that a lot on my trading room. There are lots of folks that want to do a bottom fishing play, which is basically it's done, quote unquote, selling. And I'm like, okay, fine. It started to move, but this is only a chase. It's not setting up as a trend reversal. It is facing a descending 200-day that's going to be concrete. It's going to take months before it actually turns that ship around. So we do that in the live trading room all the time. And since we've gone our power hour and Jason is asking, what about for other options? Let me remind that for on our website, LaDucTrading.com/Hans, he's got a fabulous options education program, from video to mentorship. And then for clients, he's got his own Slack channel, right? So, options mentor Hans, and offers then reduced programming for the courses and the mentorship. So there's a lot of very, very happy clients who are learning options, and some who are just really portfolio managing and they need to protect. And that's obviously something that you have done in your career for hedge funds and management of risk. So we kind of get it both. You give us the alpha trades, you also give us the protective trades. And I think that that's extremely valuable. So I'm more focused on the macro, but then I do the micro with the live trading room. And you are really educating how to trade the options. I'm placing my trade setup, but I'm not explaining it in great detail because I can't do that and also do the macro analysis and all the write-up. And run the room. So we're really collaborating here, and it's working well for clients. They're extremely happy. So I invite you to check out either LaDucTrading the service or his option program, which you can find on our website. And I'm going to wish everyone a happy new year. Hans, are we going to come back together in a week and do this at 4 o'clock so we can get closer past non-farm payrolls and closer to the FOMC and the inauguration? Maybe there'll be something new to report. Maybe we'll have some stabilization in the market and have a stronger conviction, long or short. But for right now, take care out there. It's choppy.
It is. Careful, everyone. Yeah, don't force it, and have an awesome week.
Thank you. Cheers. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.